Welcome to Iron Financial. This is where we help you forge a stronger portfolio by cutting right through the market weakness. I'm your lead analyst, and today we are putting a true titan under the microscope, MSCI. Now, these guys are the architects of the indexes that, well, literally trillions of dollars of capital follow. They build the tools, the data, the analytics, the very language of modern finance. And their latest report for Q4 2025 just hit the wire. So the question we're here to answer is pretty simple. Is this company a financial fortress built to last for years to come, or are we starting to see some cracks under the pressure? All right, let's get to work.
Okay, so let's just start right at the top with the words from the chairman and CEO himself. Now, what's really interesting about this quote is the sheer consistency it represents. Let that sink in. 11 straight years of double-digit adjusted earnings per share growth. That's not a hot streak. That's a dynasty. In a market that's just full of flashes in the pan, this is the kind of durable, high-quality performance that defines a true championship contender. It speaks to a business model that has some deep moats and a management team that just knows how to execute year in and year out. This statement right here, this is the bedrock we're going to build our entire analysis on today.
Hold on a second. 11 years is a fantastic story for the history books, I get it. But we're not investing in the past, are we? We're investing in the future. The market could not care less about what you did yesterday. It only cares about what you're going to do tomorrow. My job here is to be your voice, the voice of the investor, and to ask the really tough questions. Is this a well-oiled machine that's just going to keep printing profits, or are they starting to coast on fumes? Is that 11th year the absolute peak of the mountain, or is it just another step on the way up? That is the tension, the central question we need to resolve.
Exactly. And that is precisely why we have a process. This right here, this is our blueprint for today's analysis. We are going to forge our thesis, then we're going to hammer on those top-line revenue numbers. After that, we go deep into the engine room. We're talking profitability, efficiency. Then we're going to stress test the very foundation of this company by examining the balance sheet, take a hard look at their blueprints for the future, and finally, deliver the iron verdict. This is how we're going to figure out if MSCI is built of solid iron or if it's just a hollow facade.
So, let's get started. We're not just reading a press release here. We are deconstructing a multi-billion-dollar machine, piece by piece. We're going to take MSCI's Q4 2025 results and really test the structural integrity of this entire operation. We need to see if it can withstand the pressures of the market not just today, but in 2026 and well beyond.
Let's start with revenue. It's the lifeblood of any company, right? Without strong, consistent revenue, everything else, absolutely everything, falls apart. So let's see what the top line is telling us about the health of MSCI's fortress.
And boom, right out of the gate, we see a really powerful number, 14%, total operating revenue growth for the quarter. Now, in this economic environment, any kind of growth is good, but double-digit growth? That is exceptional. This tells me the company isn't just surviving, it is absolutely thriving. Demand for their products, for their services, it's robust, and they are successfully capturing more and more of their clients' wallets. This is the first big sign of a healthy, powerful structure. It's a heavy-duty number that sets a very strong tone for our analysis.
Okay, but hold on. We need to look inside that 14%. This is where the story gets a whole lot more complicated. This chart does a brilliant job of showing the two core pillars of their revenue, and trust me, they are not created equal. Just look at the difference. Recurring subscriptions, the steady, predictable, locked-in revenue, grew at a solid, but let's be honest, not spectacular, 7.8%. But the asset-based fees? Whoa, they just exploded, up nearly 21%. And that's the part of their business that is tied directly to the whims of the market, to ETF inflows, to asset values. So that huge growth number, it's coming from the most volatile, the least predictable part of the business. That doesn't feel like strength to me. That feels like leverage to a bull market.
I see your point, but I'm looking at this and I see a different picture. I see a powerful, diversified engine. Those recurring subscriptions, they are the foundation, they're the bedrock. That nearly 8% growth is the base that pays the bills, it funds the R&D, it's the stable core. The asset-based fees, that's the performance variable. When the markets are strong and clients are successful, MSCI shares in that success. It gives them tremendous upside. It's a 1-2 punch. But it's a punch that only works one way. When the market turns, and it always turns, that 20.7% growth can turn into a 20.7% decline just as fast. It feels like they're building a taller and taller skyscraper on a foundation that isn't growing nearly as quickly. To me, that's a growing crack. It makes the entire structure way more vulnerable to the next market earthquake.
That's a fair point, and we are definitely going to come back to it. But for now, let's move on and inspect the engine room. See, it's not just about how much money a company makes, it's about how much of that money it keeps.
profitability, and efficiency, those are the true measures of a well-run operation. So let's see how efficiently MSCI is converting all that top-line revenue into bottom-line profit.
And this right here, this is hard evidence of a finely tuned machine. Just look at that margin expansion. It's across the board. The operating margin is up almost 2 full percentage points to 56.4%. The adjusted EBITDA margin is pushing past 62%. I mean, these are fortress-like numbers. What this tells you loud and clear is that as their revenue grows, their costs are growing much, much more slowly. This is what we call operational leverage in action. Think of it like this. You run a software company. Once you've paid to build the software, every new subscription you sell costs you almost nothing extra. That's the beautiful game MSCI is playing. For every new dollar that comes in the door, more and more of it is dropping straight to the bottom line. This isn't just a company that's growing. It's a company that is becoming fundamentally more profitable over time. This is a disciplined, well-oiled machine.
A well-oiled machine? Or maybe a machine that's running a little too lean? Because here's the other side of that operational leverage coin. Their revenues grew 14%, but their headcount? It barely budged. It's up just 2.2%. In a high-tech, data-driven business like this, your people are your assets. They're your R&D, they're your client service, they're your innovation engine. So the question is, are they actually getting more efficient, or are they just squeezing their existing talent harder and harder? How long can you really sustain double-digit growth with low single-digit investment in your own workforce? I worry this isn't sustainable efficiency. It could be the first sign of underinvestment, sacrificing the long-term health of the company for some really nice-looking short-term margin gains.
That's the kind of skepticism I expect. But this waterfall chart, this right here, shows exactly how they pull it off. Let's do a little masterclass walkthrough here, because this is the anatomy of shareholder value creation. They started with adjusted EPS of $4.18 last year. First, that strong revenue growth we talked about, that added a massive 81 cents per share. Then, you see the expense discipline. That controlled spending only took back 24 cents. See? That's your operational leverage right there, turning revenue into pure profit. But look at the next bar. This is key. An extra 22 cents per share was created simply by buying back their own stock. Management is essentially screaming from the rooftops, "We think our stock is the best investment out there," and they are putting billions of dollars behind that statement. That's confidence. A few other minor items here and there, and you land at 466. This chart brilliantly illustrates it's not just one thing. It's a three-pronged attack: strong revenue, tight cost control, and really smart capital allocation. That's how you get 11 straight years of this stuff.
That's a very pretty picture on the income statement. I'll give you that. But you know, income statements only show you what happened over the last 90 days. To really understand the strength of this fortress, we have to stress test the foundation itself. And that means we have to look at the balance sheet. I want to know what this entire operation is built on, and more importantly, how much weight it's carrying. Let's talk about debt.
And there it is, $6.2 billion. Just let that number sink in for a minute. That is a massive, massive weight sitting on this company's structure. Look, in good times, leverage is your best friend. It juices your returns. But when the cycle turns, and believe me, it always turns, debt becomes an anchor that can pull your entire company under. This is not just a number on a page, it's a potential source of catastrophic failure in a crisis. This is the single biggest risk I see to the entire MSCI story.
And you're right to point it out. A big number like that absolutely deserves scrutiny. But a number without context? Well, that's just a scare tactic. It's designed to get a headline. Now, what's really interesting about this slide is how it provides that crucial context, the real story. Yes, the total debt is $6.2 billion, but look at their leverage ratio. Total debt to adjusted EBITDA is 3.3 times. Now look at the company's own publicly stated target range for that exact same metric, 3.0 to 3.5 times. They are sitting squarely in the middle of their own comfort zone. This isn't some panicked company just piling on debt. This is a calculated, disciplined financial strategy. They're telling the market exactly how much leverage they're comfortable with, and they're sticking to it. This shows control, not crisis.
And this slide right here drives that point home perfectly. This is not a single $6.2 billion bomb that's waiting to go off next year. Just look at this maturity profile. It is a well-structured, staggered ladder of debt that stretches out all the way to 2036. They have no major maturity walls to climb anytime soon. They've locked in their financing for over a decade. This allows them to manage their obligations smoothly over a very, very long time horizon. This debt is not a source of fragility. It's a permanent and manageable part of their long-term capital structure. They've built this to last.
All right, so the present looks strong, and the foundation seems stable enough. But you and I both know the market pays for future growth. So let's shift our focus to the blueprints for tomorrow.
Where is the next wave of growth actually going to come from? MSCI is pouring a ton of money into new technology, particularly around AI and private markets. So the question is, are these real blueprints for new revenue streams, or is it just a collection of really expensive buzzwords?
Well, this slide shows they are not standing still. This is a clear roadmap for the future. They are systematically attacking the biggest and most profitable trends in finance. Number 1, transparency for hedge funds. That's a huge risk management need for banks. 2, private fund metrics. As more and more money flows into private equity, clients are desperate for data. 3 and 4, they're embedding AI directly into their core index and analytics products. And 5, they're using AI chatbots to make their platforms easier and faster to use. This isn't random. This is a multi-pronged assault on the future of finance. These are the blueprints for MSCI's next decade of growth.
You know, I see a list of press releases. I see a lot of AI washing. Hedge fund transparency, private fund metrics. Sure, these are good ideas, but they are incredibly niche, complex markets. The AI indexes and chatbots sound interesting, but where is the business case? How do you monetize a chatbot? Are clients actually paying more for this, or is it just a feature they're adding to prevent them from leaving for a competitor? You need to show me the path from AI-driven platform enhancement to a tangible increase in recurring subscription revenue. Because right now, this looks like a very expensive R&D shopping list, and I'm not convinced it's a coherent strategy that's going to move the needle on a company of this scale. And that's the perfect pivot to our final section. We've examined the revenue, we've inspected the engine room, we have stress-tested the foundation, and we've reviewed the blueprints. Now it is time to weigh all the evidence and deliver the iron verdict. Is this company a true fortress, or is it just a facade?
Okay, let's lay it all out on the table. On the strength side of the ledger, the evidence is pretty powerful. You've got 11 years of double-digit EPS growth. I mean, that's a track record of execution that is second to none. You've got expanding margins, which proves they have real operational leverage and pricing power. The recurring revenue base provides a stable foundation, and their balance sheet, while it is large, is managed with clear discipline. But the potential cracks are real, and you can't just ignore them. That top-line growth is becoming more and more reliant on those volatile market-sensitive fees. That $6.2 billion in debt is a significant number no matter how you slice it. And all those shiny new AI and private market ventures, well, as of today, they're unproven. We just don't know if they're going to become the next great growth engines or just costly experiments.
So here it is, the crucial point. The iron verdict is that MSCI is, without a doubt, a fortress. The historical machine is incredibly strong, the moat around the business is wide, and the management team has proven its ability to execute time and time again. However, and this is a big however, the future durability of that fortress is not guaranteed. It really hinges on two critical factors. First, their ability to navigate the inevitable market volatility given their growing exposure to asset-based fees, and second, their ability to execute on these new blueprints to turn those AI and private market initiatives from buzzwords into real profitable revenue streams. The structure is sound today, but the future is being built as we speak.
And that leaves us with the final question, the one for you to consider. The company's proven its strength over the last decade. That's not in question. But the market landscape is constantly changing. New competitors, new technologies, and new economic cycles are always on the horizon. So as you go and do your own due diligence, the question you really need to answer for yourself is this: is MSCI's armor, forged over the last 11 years, strong enough for the new battles of 2026 and beyond? Thanks for joining us at Iron Financial.